Uh, Good morning, good evening, depending on the time that you'll watch this video. Today I want us to uh, go through the manufacturing account, and this should be relatively easier for all of us because we've done so many adjustments so far. So it's just a matter of understanding what is manufacturing account and preparing the financial statements. And you're going to notice that when it comes to the income statement, when it comes to the statement of financial position, they are more or less the same as the previous accounts that we prepared. The only difference is on the manufacturing accounts. So what is manufacturing accounts? For companies that manufacture goods or produce goods, they will have to open an account called manufacturing account to determine the total cost of production. And you know, there are companies that may decide to manufacture or produce because it saves, or it helps them to save on the operational costs. So it is cheaper to produce the goods than to buy the goods. So for these companies, they are going to incur some additional cost. And for you to know the total cost of production you've incurred, you have to open an account called the manufacturing account. And then now when you'll be preparing the income statement, you take this cost of completed goods, the income statement, and then later on you can prepare the statement of financial position. So the main purpose of the manufacturing account is to enable a company or a firm to determine the total cost of production. Now, if you are producing goods or manufacturing goods, it means that you need to have raw materials, what we call direct materials. So direct materials is composed of the inventories, the purchases that you've made, and these are mainly purchases for inventories because you need to have inputs for you to produce outputs. Apart from the materials, you need labor. These are now the manpower that will be required in the production process. And we normally have what we call direct and indirect. So for direct labor, these are manpower that can be attributed directly to the production process. Then we have expenses, other expenses that a company may incur, and also we have now the indirect expenses or the indirect cost, or sometimes called indirect manufacturing costs, sometimes called factory overheads. These are costs that cannot be traced directly to the production process, but they are part and parcel of the cost of completed goods that will be incurred during the process of producing or manufacturing these goods. So in manufacturing accounts, we normally have two main categories of cost: the direct cost and the indirect cost. So direct cost is also called prime cost. So under direct cost, which we are going to see shortly, is made up of three other subcategories. So under direct cost, we have three other subcategories: the materials that you have to buy, okay, what we call direct materials; the wages that you are going to pay for the people that are directly involved in the production process, we call this direct labor; and any other expenses that can be traced directly to the production process, we call that direct expenses. So that is the first category. You can be asked this in the exam: explain 5 types of costs. So the first one is direct cost. So under direct cost, we have direct material, direct labor, direct expense. The second category is indirect cost. Indirect cost, these are costs that cannot be traced directly to the production process or a particular unit. Okay, for example, if you pay a supervisor some wages, a supervisor does not work directly in the production process. Okay, so the wages that you are going to pay a supervisor for supervision, that will be part of the indirect cost. But a laborer who is working directly, the wages you pay will be under direct labor. Okay, rent for factory, depreciation of plant and machinery in the production process. This again forms part of the indirect cost. These are costs that are incurred, yes, but cannot be directly traced to the production process. So remember when I was telling you the categories of costs, I said we normally have 5. So the other 3 are normally found in the income statement. We have the administrative cost that you people know. These are not incurred in the manufacturing department, but in the other departments other than the manufacturing department. So we have the admin or administrative cost, we have the selling and distribution cost, and we have the finance cost. Are you together? So that is all about manufacturing accounts. So the manufacturing account that we are going to prepare generally will help us to determine the cost of completed goods. Are you together? Now, having said that, I want us to just check briefly the format of, this is the format. This is the format for manufacturing account. You can see we are starting with the direct costs. Under direct costs, we said we have direct material. So direct material is made up of the opening stock of raw material, okay, the purchases of raw material. If there was carriage inward, you add, and less return outward if there were some goods that were returned after purchases. Then we have also the closing stock of raw material, so that now you get the direct material. This raw material consumed is what we call direct material. And then from there you add the direct labor, okay, or labor that is directly attributed to the production process or particular unit. Then you add direct expenses if it is there. So when you add direct material, direct labor, and direct expenses, it's supposed to give you what? Prime cost. Okay, it's supposed to give you prime cost. Then from there now you add the indirect. You can see the next thing you add now, the indirect cost. Indirect cost is also called factory overheads, also called indirect manufacturing overheads or cost. Okay, so you add any other cost that cannot be traced directly to the production process. Yes, it is incurred in the production process but cannot be directly traced. Salary of factory manager or supervisor, the depreciation, other expenses incurred in the manufacturing department such as rent, lighting, heat, okay, wages to cleaners. You know, cleaners do not directly work in the production process, so they enhance the working environment. So add all these costs now to get what we call total cost of production. But before you get the cost of completed goods, remember in the manufacturing department, our aim here is to get finished goods so that we can sell these goods to the market, okay, at a profit maybe, right? And then the main reason is to convert inputs into output, so that the output, which now are finished goods, can be sold in the market. So I want you to notice that in the manufacturing account we are dealing with raw materials. So there is nowhere in the manufacturing account whereby you are going to have finished goods. So we normally have 3 types of raw materials, three types of inventory or stock. Normally have 3 types of inventories or stock. One is the raw material, 2 is work in progress, and 3 is finished goods. So I want you to notice that in the manufacturing account, we only deal with raw material, and later on, still in the manufacturing account, we are going also to incorporate the work in progress. Why? Work in progress means that you can have opening work in progress or closing work in progress. At the end of an accounting period, the raw materials that were not fully converted into finished goods, you're supposed to begin with those one before you procure new raw material. That's why we normally, after getting the total cost of production, you add the opening work in progress, then you less the closing work in progress. Why are we lessing the closing work in progress? Because the closing work in progress will be used as opening work in progress in the subsequent year. So always remember that we normally add opening work in progress and then we less closing work in progress. Now to get what we call factory cost of production, or what we call cost of completed goods. Are you together? Cost of completed goods. Okay. So from there now, the managers of the company may decide now to add some profit. Okay, because now remember, they have now converted the raw material or the inputs into output, and this will be sold at the marketplace. So they are going to add some profit to what they have incurred in terms of cost, okay, to get what we call finished goods at a transfer price. Okay, and now I want you to notice that in the income statement, so this is just a continue in the income statement under cost of sales. So you add opening stock of finished goods. I want you to notice that opening stock of what? Finished goods. We don't use raw material there. Raw material is used in the manufacturing account. So it is opening stock of finished goods. Then you add what? You add now the cost of production or transfer price. So you are going to notice that in some accounts or some questions, that information is not provided, meaning that there was no transfer price. Okay, so that now acts as our purchases. Remember the normal income statement, we normally say add purchases. So we don't say add purchases here, we say add the cost of completed goods that we obtained in the manufacturing account. Then now you can less the closing stock of finished goods. You compute your gross profit. Okay, you add the factory profit if it was there, any other income that is there, then you less the other expenses, the admin, selling and distribution and finance costs if it is there, for you to get your profit. You can again, if there is information about taxes, you less your taxes, then you get profit for the year. If there is payment of dividend, you pay dividends if that information is provided to get the retained earnings for the year. Okay, so that is all about the manufacturing account. I want us to go to the past paper, the November sitting, this November sitting 2020, question 4. So I'm going to read the question. So it says Term Limited is a company that manufactures biscuits. The following trial balance was extracted from the books of the company as at 31st March 2020. So we have there our trial balance. You can see our trial balance. We have debit side and the credit side. And remember, for debit side, we only have expenses and assets. Credit side, we have revenue, capital, and liability. So addition information number 1. Accrued expense as at 31st March 2020. So we have information on accrued expenses. Number 2, we have information on prepaid expenses. Number 3, we have information on depreciation. One on cost, the other one on reducing balance. You've done this before. Information number 4. So all this information will help us now to prepare the T accounts. Then we are required to prepare the manufacturing account for the year ending 31st March 2020, and then the income statement or the statement of profit or loss for the year ended 31st March 2020. We're also going to add the C part just for the sake of us learning. We're also going to add the statement of financial position. That will be a by the way, because you never know, the other exam may require you to prepare it. So we are going to begin with addition information. Number 1, accrued expenses. The first one is heating and lighting and rent. These are the expenses. So remember what we said. When you get information on accrued expenses, you ask yourself the question, is it on accrual, is it an expense or an income? Because accruals can be income or expenses. In our case, it is direct. We know it is expenses. Then for manufacturing account, I want us to go to addition information number 3. There is something important that I want you to notice there. And this one is for manufacturing account. You need to be very careful. So information number 3, they are saying depreciation and respective allocation is provided as follows. So asset, building 2% basis cost, expense admin. So you can see for addition information number 3, they have told us when we calculate those depreciation, where they are going to fall. Remember we said we normally have 5 categories of cost. We have direct, indirect, we have admin, we have selling and distribution, and finance. So for example here, after calculating depreciation, we know depreciation is going to be administered under admin. Plant and machinery will be administered under indirect cost. Indirect cost is also called factory overheads. Office and equipment depreciation will be under admin. Motor vehicle will be under selling and distribution. Okay, again, rent, rates and insurance, addition information number 4. Remember here for 1 we have heating and lighting, we have rent. Number 2 we have rates, we have insurance. So they are saying rent, rates, insurance, heating and lighting to be apportioned in the ratio of 5:1 in relation to factory and admin. So whatever we are going to get here, our balancing figure, we need to apportion it 5/6 to go to factory, 1/6 to go to administration. So 5/6 will be reported in the manufacturing account and 1/6 will be reported in the income statement. So I want us to begin with the accruals. We open the T account for heating and lighting. So we start with that one. So allow me to open my Excel. So we are going to start with heating and lighting. So we write heating so we say heating and lighting account. So for heating and lighting, remember when you open the T accounts, we've already figured that this is an expense. So we are going to go to the trial balance. Any figure that is in the trial balance for expenses should be recorded on the debit side of the T account and the narration should be paid. That means that's a figure that has already been paid for. So we go to the trial balance, we check for heating and lighting. That figure will be called paid. We've done this before. So heating and lighting, I have to check myself here. Heating and lighting, this figure is 180. Can see 180, 342. 180, 342. So 180, 342. So for accruals, we said, my friends, for accruals, we said it refers to any expense that has been incurred during the year, but payment has not been done. So there is this amount that has already been paid for, 180, 342, but there is also this 3642 that has not been paid for, but it belongs to this year. So what did we say about that? You consolidate. So you have accrual. So you are going to add all of them because it relates to this period. It belongs to this period. So we have 3642. Okay. So we are going to balance that account shortly. Remember, we had been told that the figure we get there should be apportioned to factory and admin, so in the ratio of 5:1. So we are going to come back to the balancing figure. We proceed with the next one. So the next one is rent. So we open rent account. So again, rent is an expense. We say we have paid here. So we go back to this trial balance. We check for rent. So rent is 570, 144, 570, 144, 570, 144. Then the same case for accruals. So remember what we said about accruals. So accruals, the information in the note is that we have accrual for rent of 69.63. So we come here, we add 69.63. We are going to balance that shortly. So we proceed. Then next one, let me open it on this other side. So the next one is on addition information number 2. We have prepayments, but again you have to ask yourself, is it prepaid income or prepaid expense? So it's the expense. So we start with rates. The first one is rates. So we're going to open rates account. So rates account. So again, because this is an expense, the information in the trial balance should be paid. So we come back here. So rates, we check for rates. It is 60, 348, 60, 348, 60, 348. Now for prepayment, these are expenses that you've paid in advance. It is already captured in this amount. 6348, we already have that prepaid rent. But remember, for accrual, the accrual concept states that you should record items that relate to this year only. So for prepayment, we always deduct them because they do not relate to this accounting period. So we are going to say here prepayment, we remove them because they will be recorded in the next accounting period. So prepayment here figure is, in the addition information, it was 9420. So 9420, like that. We are going to balance that account shortly. Then the other account is what? Insurance premium. Insurance premium. So for insurance premium, again, this is we've been told there was some prepayment. And we've said for prepayment, because they do not relate to this accounting period, from what we had discussed previously, we have to do away with them. Do away with them by recording it on the opposite side. That means deducting it from what has already been paid. So for insurance premium, we have the paid amount because it's an expense. So go back to this, we check for insurance. So we have insurance here. The insurance figure is 498,039. 498,039. 498,039. Let me confirm. 498,039. Yeah, it's okay. So we have the prepayment. So for prepayment, we come back here. Prepayment, for insurance, it was 10,080. 10,080. So we have 10,080. Now, before we proceed to the other additional information, you are told that the balancing figure, let us first of all get the total here. This one plus that one. That should be the total on both sides. This one plus that one. So that should be the total here. Which is the bigger value? This one, yes. This one. For again here, this is the bigger value. So we've been told, go back to that information. So we've been told in the addition information number 4 that rent rates, insurance, heating and lighting to be apportioned in the ratio 5:1 to factory and admin. So we come back to our account here. We are going to apportion this to factory and admin. Let me just use F and A. F for factory, A for admin. Balancing figure is going to be on this side. F factory, F and admin. So here the ratio is 5/6, because if it is 5:1, it means total is 6. So for factory is 5 over total, which is 6. For admin is 1/6. So we are going to say then that one should be that. This one is 1 divided by 6. Then we multiply by that. When you add these two, they should always give you 183. That one. Okay. So we should do that to all of them. Okay. So let us proceed to this other account. So 5/6 we multiplied by that is our balancing figure. The other one is 1/6. Multiply that by that figure. Okay. So we proceed. So for these other accounts, we need to calculate the balancing figure. So the balancing figure here is 63. Okay, we can do this. 5/6. We're supposed to multiply that by open bracket. It is 6348 minus 9420. We get that. Then we say again, it is 1/6. We multiply that by we open bracket 6348 minus 9420. Yes, and these two should always give you what? That difference, okay, which is 5928. When you minus this one, supposed to get that. So we do the same here. Factor it was 5/6. We multiply that by, we open bracket, it is 498039 minus 180, close that bracket, do the same, multiply that by, open bracket, 498039 minus 180. Yes, we get that. So these two, when you add these two, they should give you that difference. Okay, when you add these two, it's giving you 487959. Okay, so we continue. Sorry about that. Just a minute. Okay, proceed. Sorry for the call. So the next thing is, let us see. We are done with, we are done with all the accounts. Okay, so the next thing is now to proceed with the addition information. So addition information number 3 is about, you can see it's about depreciation. So let us continue now. Depreciation. So depreciation, remember, even for depreciation they told us about apportioning. So the first one is building. So building. So for building, let us calculate depreciation for the year. Depreciation for the year. So the rate here is 2% on cost, that is straight line method. So we are going to say 2%. We multiply the 2% by the cost. We go back to our trial balance for building. Here it is, building cost is 390,000. We have accumulated depreciation, but we are going to use this one later when you are determining the net book value. Remember, we said under depreciation, to get net book value, you take cost minus accumulated depreciation minus depreciation for the year. So what we are computing here is depreciation for the year that is going to be recorded in the income statement. So building cost is 390. Come back here, so only 2% of 390,000. So we get that. So to get net book value, then net book value that will be recorded in the statement of financial position, we are going to say 390,000 minus accumulated depreciation, which is 30,000, then minus depreciation for the year, which is 7,800. So you get that. So we are done with building. But remember, we were told for depreciation for the year, this figure here, let me add a line here, 2 lines. There was information. If you go back to the addition information, they said we should record that in the admin. Okay, admin. So that one is okay. There was no need even of adding. So we know this one is going to go to administration expense. Okay, it's important to know that administration expense. So let us proceed with the next one. So the next one is plant and machinery. Plant and plant and machinery. So again, we compute depreciation for the year. So depreciation for the year for plant and machinery, 15%, and it should go to factory. 15%. So let us go to the trial balance to check the cost for plant and machinery. Plant and machinery, yeah, here it is. Plant and machinery, 2,190,000. 2,190,000. So we get that. This one will go to factory expense or overheads. Okay, that is a good example of indirect cost or factory. So let us compute the net book value. So net book value, we are going to say the cost, which was 2,190,000. Then we get the accumulated depreciation for plant and machinery. Here it is. Plant and machinery accumulated depreciation, you can see here it is 673,500. 673,500. Then we less depreciation for the year, which is 328,500. So that is our net book value. This one will be recorded in the statement of financial position. This one, statement of financial position. So we proceed, my friends, with the depreciation. So the next one in the addition information is what? Is office equipment. So office equipment. So we compute depreciation for the year, and we also compute the net book value. So for office equipment, what is the rate? The rate is 10%. Rate is 10%. So we ask ourselves, what is the cost? Go to the trial balance. Office equipment, the cost is 330,000. Here it is 330,000. 330,000. So that will be recorded under what expense? They said under what expense in the admin it is. So this one is admin expenses. Okay, admin expenses. So to get the net book value, we are going to say the 330,000. We subtract accumulated depreciation. So we have to go back and check the accumulated depreciation for office and equipment, which is 73. Here it is 73,500. 73,500. Then you less the depreciation for the year, which is 33,000. So this is the net book value. Then finally, under depreciation, we have another one called motor vehicle. And for motor vehicle, we've been told that this one is going to go to distribution, but the basis for calculating depreciation for motor vehicle is reducing balance. So remember, reducing balance, you have to subtract what? The accumulated depreciation for you to get what? Depreciation for the year. So motor vehicle is 25%. So we're going to say here motor vehicle. Motor vehicle, we have, so we are going to say depreciation for the year will be 25%. Then we open bracket, because remember, for reducing balance, you have to subtract the accumulated depreciation from the cost. So the cost is 600,000. So 600,000 minus the depreciation for the year is 240,000. 240,000. So we get what? 90,000. So for net book value, then we are going to take the cost, which was 600,000. We subtract the accumulated depreciation, which was 240,000. Then you also subtract the depreciation for the year, which is 90,000. So that is going to be recorded under, they told us motor vehicle is going to be recorded under what? Under distribution. So selling and distribution, SD, this one is going to be recorded this, the net book value in the statement of financial position. So at least we are done with addition information number 1, 2, 3. We're also done with 4, the basis for allocation. So let us go to addition information number 5. So for number 5, it reads the director's salaries include 20 million, but for consistency, let's just say 20,000. Remember, our figures are in thousand. So 20,000 or 20 million paid to the production director at office salary of 64,237,000 paid to salesmen. So director salary. So we are going to open an account called director salaries, and these are expenses. So let us go to trial balance to check whether we have director salaries. Here it is. So director salary, here it is, and the figure is 90,306. Remember, the figures here are in thousand. So this is like 90,306,000. So we open director salaries to adjust that account. We can do it somewhere here. Here, directors. They have called it what? Directors or director salaries. So remember, directors are generally involved in the management affairs of a company. But here, in the addition information, they have mentioned sales. So it means that in terms of distribution of cost, we have to be careful here, because some cost will be recorded under the manufacturing account, others will be recorded under maybe admin, because the director salary is under administration. But for sales, that one is under selling and distribution. So we have the paid here in the trial balance, which is 90,306. This one 90,306. But this figure includes, go back to the addition information, it includes, so director salaries include 20,000 paid to production directors. So we are going to less for production directors. Why? Because we want to record the production directors in the manufacturing. So this one is supposed to go to the manufacturing. So I'm going to include somewhere here. So I'm going to say production director, the figure was 20,000. So this figure we are going to record it under indirect cost in the manufacturing account. So we need to remove it under the director salaries, because director salaries will be recorded under admin. Directors are usually involved in the management of an organization or companies, so their salaries are normally recorded under administration expenses. So we are going to remove for production director, because the production director is going to be recorded under manufacturing account. Why? Because these are people who are involved with the responsibility of managing the affairs of the production process of a company. So whatever will be paid to them should be under manufacturing cost. And then the other one is office and office salaries. So office salaries, this one will be under office salaries of 64,237 paid to salesman. This will be distribution. So salesman, this is selling and distribution expense. Okay, so the figure is the figure here is 64 to 37. 64 to 37. So we are going to write here salesman. So 64 to 37, we are going to record that under selling and distribution, so that now here we can get the figure that we are going to record in the admin. So this is our total. So we are going to say income statement under admin. So we have this minus that minus that. So that is the figure we are going to record under admin. So we are done with that. So the second one, the other one is allowance for doubtful debt is to be maintained at 1% of the account receivables as at. Remember when you are discussing about allowance for doubtful debts, you need to know whether it is for the year or as at. So this one is maintained at the end of the year. If you go to the trial balance, you check for allowance for doubtful debts at the beginning of the year. So the beginning of the year was 3,000. We are going to calculate at the end of the year, meaning we can be able to get in between what we call allowance for doubtful debt for the year, and that will be recorded in the income statement, either as an expense if it was an increase, if it is a decrease as a income. Are you together? So we open an account called allowance for doubtful debts. So allowance for doubtful debts. Allowance for doubtful debts. So we have, you've noticed that the allowance for doubtful debt, just like accumulated depreciation, for the at the beginning of the year, the balance brought down is always on the credit side. If you check the trial balance, you know the trial balance should guide you. Allowance for doubtful debt, it is on the credit side, 3,000. So that one should be there, 3,000. Then we are going to compute the allowance for doubtful debt at the end of the year. At the end of the year, and that is what we call allowance for doubtful debt as at, or at the end of the year. We call that balance cut down. So this one is, we are told it is 1%. So 1% is 1% of, let us check the addition information. We are told addition information number 6, allowance for doubtful debt is to be maintained at 1% of the account receivables as at 31st March 2020. So let us go to the account receivable. What is the closing inventory? Closing debtors, or closing should be somewhere here. Should be somewhere. Receivables. Check for the receivables figure, and then you. Where is the receivables? Receivables. Where am I not tracing the receivable? Here it is. Account receivables and account payables. The one on the debit side is receivables, the one on the credit side is payable. So 1.5 M. So we are going to say the one that you maintain for purposes of doubtful debt is 1% of that amount. So 1% of 1.5. So we have what? 15,000. So we balance this account. So if there was an increase from the beginning, from the value at the beginning to the value at the end, then we call that increase. So you can see there was an increase in allowance. So increase in allowance for doubtful debt. So the difference is 12. The difference is 12,000. So that will be recorded in the income statement as an expense. We can record it under selling and distribution, because debtors are people who buy goods on a credit, or you make credit sales to customers who we call debtors. So this one should be under selling and distribution. Okay, so we are done with that. But now you also need to be careful for account receivables. For account receivables, just a minute, someone is calling me. Just a minute. So we continue. What was I saying? I've even for account receivables, I was saying so for account receivables, I was saying that we need to know the figure that we are going to take to the statement of financial position, and that figure is the 1.5 M. We subtract the allowance for doubtful debt at the end of the year, which is 15,000. If we had bad debts, we could have subtracted the bad debts from the account receivables figure, but I have not seen bad debts anywhere. I have not seen bad debts and addition information. So that's the figure that we are going to record in the statement of financial position, 14,85,000. So inventories, these are the closing inventories. Remember, I told you that we normally have 3 classes of inventories: raw material, work in progress, and finished goods. Then additional information number 8, we've been told the factory produced 1,500 units. These were the units that were produced at the end of the year, meaning they were able to convert inputs into 1,500 output. Okay, only 100 units were in inventory as at 31st March 2020, meaning that out of the 1,500 units that they produced, they sold 1,400, meaning closing inventory of finished good should be there 100 units. But you need to know what was the cost for each unit for you to get the value for closing inventory of finished good. We are going to see that and income statement when we'll be preparing the income statement. Then we'll be told the corporate tax will be 100 million, that is 100,000. So we are required to open the manufacturing account. So let us now open these accounts. Okay, so we are done with the adjustments. So I'm going to open it somewhere here. So the name of this business was what? Term Limited. Term Limited manufacturing accounts for the year ended. For the year ended when? 31st March 2020. Yeah, 31st March 2020. So remember, under manufacturing account that we are interested with the cost, the direct material, direct labor, direct expense if it's there, the indirect manufacturing cost, then you get factory cost, then from there you add the opening work in progress, you less closing work in progress, and then you get the cost of completed goods. So we start with direct material. So remember the direct material, we always start with the opening inventory of raw material. Here we are dealing with raw material. Don't forget that we are dealing with raw material. So let me put here shillings. So let us go and take the figure for opening inventory. We go to the trial balance. Opening inventory should be somewhere here. 1st April 2019, yes, to 10,000. So we record the 10,000. Then you add purchases. So purchases, yes, purchases raw material is 1,555,800. So 1,555,800. Check whether we have carriage inwards, return outwards. So we have return inwards. Inwards is for sales, so we are not going to record that. But do we have return outwards? I can't see return outwards. Carriage inwards, I can't see carriage inwards. So we don't have those. We don't have return outwards. So if we don't have return outwards, we proceed with less closing inventory raw material. Yes, raw material. So it is supposed to be less or minus. So if you go to the addition information, number 7, we have the raw material at the end of the year, which is 56,200. So 56,200. So this should give us now the direct material. So direct material, then we have that. We add all this. Then after that, we go to direct labor. These are the direct wages to people working at the factory. So direct wages, again, you come back here in the trial balance, check for wages. Check for wages. Do we have factory power? Those are indirect. Office salaries, rates, advertising rate, maintenance, plant, director, heating. Manufacturing wages, here it is, manufacturing wages, it is 1504,200. 1504,200. Let me confirm the figure. 1504,200. Yes, we are done with that. Then the next one, if it is there, is direct expenses. This one in most cases is not usually there. It's rare to find direct expenses. Things like, what a good example is wages, hiring a crane driver. Okay, that is direct expenses, hiring a crane driver. So we don't have that one here. So next we go to indirect. We go to indirect. Calls are disrupting my classes. So we have indirect manufacturing. So indirect manufacturing cost. So indirect manufacturing cost, we have a good number. Let's start with what we have in the trial balance. Then we can merge with what we had computed. So any other cost that we've not recorded in the that is not admin and distribution or finance should go to indirect manufacturing cost. So let us start. Factory power. Factory power is supposed to be here. So factory power, let's see, the figure is, you need to have a ruler. It is 90, 042, 042. Then next is office salary. That one is and in the income statement, insurance income statement. You are told to apportion, remember. So we have to go back. We are told to apportion. Let's go to addition information here. We are told to apportion these to 5/6, 5 to factory, 1 admin. So heating and lighting, let me write them. We have heating and lighting. The other one was rent. The other one was rates. Then we have insurance. So let us begin with heating and lighting. So remember we had calculated that. So heating and lighting for factory, F was for factory, that one. Take it there. Then rent it is here for factory F. We take it there. Then rates was somewhere here. F for factory, take it there. Then insurance was somewhere here. F, yes. So we are done with those 4. Okay, done with those 4. Then remember there was also this one, factory, that is plant and machinery depreciation. So depreciation we can write here, depreciation, plant and machinery. So depreciation, plant and machinery. So let us find the depreciation, plant and machinery. Here it is, yes, here it is. Put it there. Any other thing that's, there was these issues to do with the directors. So production director salary is supposed to be under. So production director salary, production directors salaries. So we had done that. It is somewhere here. Yes, this one was 20,000. Yes, so any other thing that's supposed to go to the factory that is in the addition information, let's see. Okay, so we can go back now to the trial balance. So anything else that is that should be recorded in the manufacturing that has the name plant or factory, we take it to the manufacturing account and indirect cost. So we are done with this. So this maintenance plant, maintenance plant. So the maintenance plant, let's see, 120, 189. 2189. Then after that, director salary, we are done with that. Heating and lighting. So for heating and lighting, did we have that info? Yeah, we were done with heating and lighting, yes. Then we have bank purchases, return inwards, transport expense, manufacturing wages, allowance for doubtful debt, inventory. So it seems we are done with everything that should be recorded under the manufacturing account. Yeah, so we can go ahead and get the total here, taking the sum of all this. Then we get what we call, by the way, you get what we call factory cost. Factory cost, let me put a line here. So that and that you add direct material, direct labor, direct expense, and indirect. You add all of them. So to get that. So from here now, to get the cost of completed goods, you need to add opening work in progress, then you less closing work in progress. For consistency, let me write the name work in progress in full. Yeah. So the opening work in progress is in our trial balance, which is 3. Okay, it is 398,000. 398 or 378? 378,000. Then closing work in progress should be in our addition information number 7, which is 47,190. 47,190. So this one should give you what we call cost of completed goods. Cost of completed goods. So you just add this plus this, because of the negative sign, also plus that. So you get that. Okay, to get up to that point, I hope we are together. So there was an addition information, that was addition information number 8, that the factory produced 1,500 units. So it means from this cost, if you want to get the cost of 1 unit, so this is the cost of the 1,500 units. So to get the cost of 1 unit, you simply divide that by 1,500. So this is the cost for 1 unit. What about now the cost of the remaining 100 units? And this should give us what we call finished raw material, finished, what we call closing finished. You know, we don't have the value for closing inventory of finished goods. So closing finished inventory. So we are going to say it is the 100, we multiply that by this. So this value here is the value for closing inventory of finished good. Okay. So from there now we can proceed and open the income statement. Open the income statement. we are required to open the income statement. So let us open the income statement. I'm going to replace this with the word income statement. So we start with sales. So for income statement sales, let us check the trial balance, the figure for sales. So where is sales here? Sales. Sales should be on the credit side. So let us try to trace it together. Yeah, it is there. It is 7,800,441. So we put it there. So that is that. Remember, there was less return. If you can remember, we had return inwards. So we need to subtract the return inwards. For sales, we had return inwards. So return inwards is return inwards was somewhere here. Here it is, return inwards 45 318 45 318 45 318. Because it is less, let me put a negative sign there. So the net sales figure is that. Then we say less cost of goods. So remember, now in the income statement we are going to use opening inventory. I want you to be careful here of finished goods, because you're already done with raw material in the manufacturing account. So opening inventory of finished goods. So it is there in the trial balance. Here you can see it is here 750,000. So you record it there, 750,000. Then you add cost of completed goods. You don't use purchases here. Now you use the cost of completed goods from the manufacturing account. And here it is. Then you say less closing inventory of finished goods. It is there. We've already computed it. Finished goods, they had 100 units. Okay, so that is that. So to get the gross profit, so we add that. So gross profit will be that minus that. So that's our gross profit. So we check whether we have other incomes. Whether we have other incomes. How do you know we have other incomes? You check the credit side. So credit side allowance for doubtful debt, that's not other income. Bank, this is an overdraft. It seems we didn't have other income. Yeah, we didn't have other income. In the addition information, we didn't have other income too. Yeah, and the allowance for doubtful debt was an increase, so we don't have other income. So instead, we can just say expenses. We don't even have discount receipt, blah blah blah, those stuffs. Yeah, we don't have. We really don't have. So we're going to say expenses then. expenses. So let us begin with administration expenses. So we begin with what is already there in the trial balance. We have general. You can see here we have general administration expenses, general admin expenses. So the general admin expenses was 189,033. Then next we have what? So bank interest, that is finance. Factory power, we are done with that. I hope we recorded factory power. I really hope so. Yeah, we had recorded that. So let us continue. Office salaries. We were told. What were we told about office salaries, by the way? Let us go to the additional information. The director salaries include 20,000 paid to production directors and office salaries of 64 paid to salesmen. Oh, so it means we have directors in office. Let us check office salaries. It was, so it means we were supposed to open an account for office salaries and account for directors. So let us go back to our account. Let's go back to our directors account. So for directors account, we were told, here it is. Need to be very careful here not to get it wrong. So for directors salaries, let us check again. It says the director salaries include 20,000 paid to production director. That one we took to manufacturing, the 20,000 for directors. Okay. Then and office salaries of 64,000 paid to salesmen. So we were supposed to, this one is not supposed to be there for salesmen. So that now what we'll be recording in the admin under director salaries is 70,306. So let us open for office salaries, because this is an office salaries. So we open for office salaries. So the paid value here, was what for office salaries? It was this is 138,081, 138,081, 138,081. Then now we remove for sales, which was 64. So the figure is going to remain the same, the selling and distribution. So that, then now we say the balancing figure should go to office salary, that is admin IS income statement. Yes. So now we go back to our accounts here, and administrative expenses, we start with director salaries. The director salaries, we have it here, we've computed here this balancing figure. Then we have now the general salaries for the other employees, office salaries. We've also computed it. also computed it where? Somewhere here, yes. Here. Then let us not forget allowance. Allowance for doubtful debt. So allowance for doubtful debt we had computed, it was actually 12,000. You can remember. Increase, it is, yeah. Let us check now for any other item. So factory officers we are done, insurance rates we were done, advertising, rent we were done, maintenance we are done, director salaries we are done. Wait, heating, lighting, advertising we are not yet done. So advertising expenses, that will be under selling and distribution. We are going to record that under selling and distribution. So bank, this one is an overdraft, purchases, return inwards, transport expense, let us record that under distribution, wages, allowance for doubtful debt. Even for allowance for doubtful debt, let us remove it under admin. Okay, so we continue. Let us move this under admin, or let me do this. Let me show you. So here we are going to have selling and distribution expenses. So under selling and distribution, we have also advertising. So advertising expenses, it is 150, 513. Then we also have which was the other one? We had what? We had advertising. So under office salaries, remember under office salary we had salesmen salaries. Okay, so salesmen salaries again, salesmen salaries. So we have an account for that. We had record, yeah, here it is 64. Supposed to go to selling and distribution. Yes, and then we have transport. So transport expense is already there. Transport expense is 255,039. 255,039. So do we have any other item we've not recorded? I don't think so. So the only item remaining is bank interest. That will be under finance cost. So the last one here is finance expenses, and we have bank interest. So the bank interest is 21 to 10. 21 to 10. Yes, and remember, before we conclude with the expenses, we had depreciations for these other items. For example, if you go to the addition information, you are told that building is supposed to go to buildings are supposed to go to admin. So we come back here, building, depreciation for building. So depreciation for building. So let us check it somewhere. We had recorded it somewhere. Building, depreciation for building. Here it is. Yeah. And then we also have depreciation for another item. It was for what? Under admin, office equipment. So depreciation for office equipment. So depreciation for office equipment. So depreciation for office equipment. Here it is, 33,000. Then the other item was what? The selling and distribution. We have depreciation for motor vehicle. So let us add that. Depreciation for motor vehicle. So depreciation for motor vehicle, go back. Yes. So I think we are done with those. Yes, so let us add the expenses. So we start with the admin. So we have that. We have that. And we have that. So to get the net profit before tax, so this is profit before tax. We're going to say the gross profit that we got, this one, minus admin, minus what again? Selling and distribution, minus again the finance expense. So we get that. Then remember we had taxation, so less tax. So the tax was, we were provided with the value for tax. Corporate tax is 100,000. So we can get profit after tax. So we have profit after tax. Then from there we can less now dividends. Can less dividends. And the first one, remember we had different categories of dividends. If you come back here, we have interim dividends on preference shares. You can see this one, interim dividends on preference shares. Yeah. So interim dividends on preference shares. Now, interim dividends on preference shares is not going to appear in our statement of financial position because it has already been paid for. this 30,000. Okay, it's already been paid for. But if it was in the addition information, then we could have also recorded it in the statement of financial position, because it means it has been provided but not paid for it. Okay, so let us get this. So this one is going to be this one minus so we have that. So I don't know whether in the addition information there was information on dividends, so that we don't leave anything out. We don't have information on dividends, so that was the only dividends on preference share. So my friends, if you add now the retained profit from the previous period, you are done with the question. So we call this retained earnings for the year. Retained earnings for the year. Then we can now also add the retained earnings brought down from the previous years, and that one is there. Here it is, 1st April, it is 127,425. 127,425. Let me confirm, 127,425 here. So that now you get what we call retained earnings carried down. So you add the two. So the question requires us to calculate the two, but I want, as an additional, I just want us to prepare also the statement of financial position. You can prepare the statement of financial position too. So statement of financial position as at that time. So we start with the normal one, non-current assets. So for non-current assets, we have couples, and remember we had already computed the net book value. So we have building, plant and machinery. So we have building, we have plant and machinery, we have office equipment, and we have motor vehicle. So for building, we had already computed for this, so we check the value for building, a net book value. Here it is, statement of financial position. Yeah. For plant and machinery, again we had computed that. For office equipment, that, and then motor vehicle, that. So let us check whether we have any other asset in our trial balance. So building, we are done. There is land. You can see there we have land which is 120,000. So we include land, it's 120,000. So from there we can proceed with the current assets. So for current assets we have receivables. Don't forget, we had receivables. And then now for inventories, now you have to be careful here. For inventories, you add all closing inventories, whether, so if inventories you add whether work in progress, raw material, okay, and finished goods. And then we can now add the prepayments. Okay, we are going to check for prepayments. So for receivables, we had a value for receivables. We had computed the value for receivables at the end of the year. Here it was here. Yeah, that is the value for receivables at the end of the year. Inventories, let us begin with the work in progress. These figures are there in the addition information. So if you come to addition information, so raw material closing is 56,200. So material is 56,200. Work in progress is 47,190. Finished goods, we had computed for finished goods, remember, and it's also there in the income statement. So finished goods, we had computed for finished goods. Here it is 3457 blah blah blah. Then let us now check for any other item that's supposed to be recorded under assets that we've not included. So we can check. So the bank here is an overdraft, so that one will be under liability, and you can see it is on the credit side. We don't use opening inventory, we only use closing. So from there now we can check for the prepayments. So we had prepaid rates, The figure for prepaid rates is what? 94, it was 94.20. Then we also have prepaid insurance. So the figure for prepaid insurance is 10,080. Why are we recording this one? Because you paid them in advance and the accounting period is not yet arrived for, so it's like an asset. So I hope I have not left anything else out. So we can add all this to get that. So total asset will be the summation of everything here. So we have total assets there. Then now we can say financed by equity and liabilities. So we begin with equity. So under equity we have a couple of items. So here we are going to check the credit side. We have ordinary shares, ordinary share capital. So we have ordinary share capital of what? You can see here the ordinary share capital is 1.2 M. Yeah. Then we have preference share capital. So for preference share capital, we have what? 600,000. Then remember, now we have the retained earnings. The retained earnings carried down from our income statement, we need to bring it here. Here it is. So that is fine. Let us check whether we've left anything else under equity. So we are only checking the credit side. Yeah, we are done with that. So we move on to the liabilities. So under liabilities, we have non-current. So we have non-current liabilities. These are long-term liabilities with a maturity of more than 1 year, and I can't see any. We don't have debentures, we don't have long-term loans. So we don't have. We proceed to current liabilities. Maybe I can put here mean there was none. So for current liabilities, we have a couple. Start with the bank overdraft. How did I know it's a bank overdraft? It is on the credit side. Okay, so on the credit side. So bank overdraft of 150,060. 150,060. The other item is account payables. So account payables 1068, 1068, then 678, then anything else that's supposed to be on that side before we conclude with the accruals. So we had accruals. Yeah, accruals is heat and lighting and rent. So the first accrual there, heat and lighting, 3642. Then the other one is 6963. Then we also had corporate tax that was provided. Corporate tax was provided, it has not been paid, so it's also it's a liability. And it was for 100,000. Let us check. Yes, 100,000. So anything else we've not recorded? So here we are supposed to get the total. Total equity and liabilities by taking the sum sum of everything, that is 43,24,030. So there is a deviation. Let us check whether we've left. I think we've left an item. It's an item we've left probably. Let us check if there is anything we've left out. Ooh. Let us check something here. I don't know. Yeah, for administration cost, we were supposed to remember when you were apportioning. Don't know how we forgot that. When you are apportioning, we are supposed to apportion for. Remember for admin, the same thing we did for 1, 2, 3, 4. They were 4. How did we forget that? Remember when you were doing that for the manufacturing, it was heating, lighting rates. You are supposed to apportion the same thing here and the income statement. So let us do that. We forgot that. So for factory admin, we had computation for that factory. The first one was admin, that one. Then we have heat and lighting. Heat and light. The first one is factory power. The first one is factory power. So for factory power, oh, I took the wrong items. I took the wrong items. Let me go back. Supposed to be to start with heating and lighting, rent. Oh yeah, these ones. Yeah, I picked the wrong items. Supposed to be those ones. So we begin with heat and lighting. So admin, that one. Then rent, that one. Then rates, then insurance. Yeah, so that means this figure will change to that. That will change our, yeah, that will change almost everything there. Let's see. So that one also affect our retained earnings. Now you can see it as balanced. 4107 367, 4107 367. Now it's okay. We had left those items, so it is now okay. The figures have balance. So that's how you prepare the manufacturing accounts, and wish you all the best. Bye bye.